Thank you for coming. So as Boxer described, we're Steakhouse Financial. We aim to pioneer in open and transparent finance. And a lot of the chefs at Steakhouse are ex-TradFi. So we try and take best practices from TradFi and try and apply those to DeFi as well. We are a Web3 native advisory. We're best well known for being the finance workstream at MakerDAO and LidoDAO. What we help the DAOs with is, first of all, financial reporting using useful tools like Dune Analytics. And there are data chefs here in the audience, so shout out to Shogun and Sergi. And on top of that, we try and help DAOs also make good financial allocation or capital allocation decisions. We also have started to create financial products, leveraging our DeFi knowledge. So we're best well known for our Morpho Vaults and Mellow Vaults. And last but not least, we are RWA and stablecoin nerds, as well as Dune Analytics enjoyers. So today my talk is going to be about financial reporting and the importance of financial transparency. And I want to lead with this interesting data, which I created. You can't really see it, but to kind of give you the TLDR, the top half of the list consists of tokens whose revenues have grown at a slower pace than their token emissions. It means that on a per token basis, their revenues are declining. And this cohort of tokens, on average, returned 16% in token price. Contrast that with the bottom half, so the stuff that you see in green. These are protocols whose fees have outpaced the growth of their token emissions. So put another way, their per token fundamentals are improving. And this cohort of tokens have on average returned 243%. So we're seeing this clear dichotomy between tokens whose fundamentals on a per token basis are increasing and improving, and those whose not. And that kind of gives me confidence that even though the crypto market is so crazy, actually protocol fundamentals are starting to become important for token prices. And this is hugely encouraging for ex-TradFi fund managers like myself who've pivoted to crypto, who, from the outside initially thought crypto was all about speculation. But actually, we may be seeing the beginnings of fundamentals starting to matter for crypto tokens. So going back to kind of the stock market, let's look at what public companies have to do for financial reporting. So since 1934, the Securities Exchange Act, in the middle of like the biggest bear market of modern history, the SEC, the financial regulator, was established. And along with that, public companies were mandated to file annual reports called 10Ks with the SEC. This is every public company has to adhere to this mandate. And 10Ks are often 200, 300-page reports that are quite dense, and it is the job of a fundamental analyst or a fund manager to parse through all their information to understand what's going on with the company. So they provide investor information, they standardize reporting. There's a whole risk section which covers what are the risk factors the company is facing. And the overall goal of a 10K report is to give market information as well as confidence. But right now we're kind of like rebuilding this whole financial system in crypto. Tokens are speculating, and we have 100% volatility kind of asset class. There really isn't any regulation that all protocols have to adhere to. But we thought it would be really cool, being from TradFi, to try and kind of innovate on this front by creating what we call a 2023 retrospective report. So if you go on the Steakhouse Financial website, you can find this report. It's only 50 pages, so much shorter than a typical 10K that we see for public companies. But we try to format it in a way that kind of replicates the style of a 10K to give people information about, one, how MakerDAO works, two, what are the risks that the protocol is facing, and three, its financial history and evolution of its financial fundamentals. So feel free to go to our website to have a look. The reason why I want to present the economics of this is the fact that we use Dune analytics heavily for real-time reporting, and you'll see that as part of this presentation. Right. So MakerDAO, for those of you who are not familiar with MakerDAO, it is probably the first DeFi project ever started. It was actually conceived even before Ethereum became a thing. So it was co-founded by Rune Christensen, who still is contributing to MakerDAO. It is the world's largest decentralized stablecoin at just under 6 billion in circulating supply. We can represent the Maker protocol in a financial sense. So if you were to describe, the assets and the liabilities of Maker protocol, it would look like this. So on the liability side is the DAI, the stable coin that users mint against their collateral. So minted DAI represents the liabilities that that Maker protocol has to the users. And DAI actually comes in two forms. One that does not provide users with rewards, and two, the S-DAI, staked DAI, which provides users with additional rewards, or the traditional finance counterpart would say yield. So if you hold S-DAI, you earn what's called a DAI savings rate, which varies along with market conditions, but I think right now it's something like 6%. So on the asset side of the balance sheet is the collateral that users have put up to mint DAI. And the protocol's job is to be able to allocate this assets or collateral into yielding opportunities that will generate income for the protocol. And over time, the breadth of assets that MakerDAO can invest into has increased. Initially, it was just Ether, and then it transitioned to multi-collateral DAI. And then most recently, it's pushed into real-world assets, notably T-bills, US T-bills. And the difference between the asset side of the balance sheet and the liability side of the balance sheet is what we call a surplus. And the surplus is used to buy back MKR tokens, creating deflationary pressure on the token. So how does it make money? How does Maker make money? If we were to kind of fit it into, traditional finance template and say this is the income statement of MakerDAO, it would look as such. At the top, you've got stablecoin supply. So for those of you who are familiar with Maker, it's actually rebranded. It's ran to Sky, and DAI was also rebranded to USDS. So I'll refer to DAI, but right now we're talking about the combined supply of DAI and USDS. So at the top, the protocol grows by expanding its DAI in circulation. So you have to create additional demand for the stablecoin and for the users to want to mint DAI. From there, the collateral that users put up can be deployed to different assets to earn fees. So that's what we call gross interest revenues. That's basically how much collateral there is and what rate you can earn the fees on this amount of collateral. As discussed, the token holders who choose to stake their DAI, so hold S-DAI, are paid a reward. So that's actually like an expense to the protocol. So you have to subtract the DAI savings rate. And the difference between gross interest revenues and DAI savings rate is basically the income to the protocol, and it's called net interest revenues in traditional finance terms. Of course, the DAO also has developers and people who contribute to the development of the DAO, so it will have some operating expenses associated with the workforce. So subtract that, and then you get net operating earnings. And this is exactly the amount that's available to buy back MKR tokens, which creates kind of upward pressure on tokens because you're talking about kind of dividing the pie into smaller pieces. So I'll go through kind of very quickly the trends we've witnessed in 2023 relating to each of the elements that feature on the income statement of Maker. So first with the stablecoin supply. This is basically how since 2020 the DAI USDS combined stablecoin supply has evolved. So of course we're probably all familiar with DeFi summer of 2020, 2021. DAI supply just expanded like crazy to nearly 10 billion. But of course, following that was the collapse of Terra Luna and the subsequent deleveraging for crypto loans that we saw in the bear market. So the supply of DAI and DAI kind of cratered. And we might be coming into now another bull market, so we're very hopeful that the cyclicality will go in the opposite direction. Today, the combined DAI USDS supply sits at just under 6 billion. It's worth noting that in the blue of the graph, you see the amount of DAI that sits in the SDAI. So this is the earning form of the stablecoin, and DSR, DAI savings rate participation out of all the holders actually increased from nearly 0 to 30%. So 30% of circulating DAI is actually earning rewards. Turning to gross interest revenues, the chart here shows how the collateral or the asset side of the balance sheet is allocated. So this is a very broad classification of the type of assets that are sitting on the asset side of the balance sheet. You initially started with crypto vaults, so this is like the Ether, other crypto that was backing DAI. But over time, you can see, especially in 2023, in the light green, really spiked up. And these are RWA vaults, real-world assets, so deployment into U.S. Treasury bills. And this, went up to nearly like half of the balance sheet. And really correlated with the increasing interest rates that provided a great opportunity for MakerDAO to start earning yield on the assets. One thing also to note is that Maker is becoming more savvy and efficient in its capital allocation. So meaning in 2023, nearly all of the assets were deployed into earning opportunities. This figure, so 95% of assets were deployed into earning opportunities. This figure increased from previously 50% in 2022. This chart shows just the evolution of rates for crypto vaults. You can see in the depth of the bear market, there was very little of demand for crypto loans. So the vaults were earning, next to nothing. And as 2023, the year progressed, crypto loan demand returned, prompting MakerDAO to raise vault rates. So that provided increasing revenues, and we can see that in the next chart. This is monthly revenue for MakerDAO by year. So the blue line shows the progression for 2023, and as a result of both increasing rates but also savvy allocation of collateral, we've seen record income, record interest revenues of over 100 million accrued to the protocol in 2023. On the expenses, liabilities. So as discussed, holders of SDAI earn DAI savings rate. So this is a cost to the protocol. In the blue is basically the amount of SDI. So you can see that basically from zero, people are starting to be more savvy and choosing to earn rewards, and they're pushing their DAI into the staked version. And then on the yellow is basically how the DSR evolved. So as the rates of the market picked up, makers started raising the DSR, making it more attractive for users to want to stake. So yeah, in 23, there was over 30 million paid to the holders of SDAI. So the difference between the earning of the assets or the collateral and the cost to the protocol in terms of paying out to SDI holders is net interest revenues, and you can see that the net interest margin has expanded over time. What I thought was really interesting was actually when you look at US financials, on average, this net interest margin hovers at around like 200 to 300 basis points. But what's really interesting is that Maker, on a last 12-month basis, has even exceeded that. So I think net interest margin was something like 350 basis points, indicating that actually there are some comparable points between, this Web3 bank and a traditional bank that we see in the US. This chart, again, just summarizes very high level Maker's P&L. And the excess revenues are used to buy back Maker MKR tokens. Cumulatively, 10% of total MKR tokens have been bought back. Initially, the bought back tokens used to be burned and permanently destroyed. But over the last few years, they've thought, actually, instead of just burning tokens, we can do something more useful with it. So they adopted this strategy called buyback and LP, whereby the bought back tokens are LP'd into a Uniswap v3 pool paired against DAI to create better liquidity for its governance token. This is sort of like then adopting a TradFi mindset. We know when you divide the fundamentals, so earnings, by the amount of tokens outstanding, we get this per token metric. And this chart just shows that on a per metric basis, Maker's been growing at 3 digits on average per annum, which is very kind of high growth in terms of if you compare it to an average company in the S&P 500. However, its price multiple, so how the market values its growth potential, has cratered. Today, I'm not giving you any investment advice or anything like this, but MKR trades at 22 times price to earnings, which is very comparable to an average price multiple of an S&P 500 company, and debate and discuss whether Web3 grows faster or slower than an average S&P 500 company, but it's still interesting to observe that there is potentially a market inefficiency here. So to wrap up, let's compare this current state of reporting landscape for US public companies versus protocols. Obviously, there's no requirement right now, but there's a lot of potential for protocols using things like Dune Analytics to outshine, what public companies have to do. So that, block settlement times are much faster. You can do real-time reporting. Anybody can access the data on the blockchain, so you don't have to wait for the company's finance team to put together, the financial reports. Anyone literally can do what we've done with MakerDAO, reporting, and then also the fact that it's, an open forum where people can ask the teams questions on Discord and social media versus in a private company or public company context. Management is often only offered to big institutional investors with a lot of capital, so it kind of disadvantages retail. So I'll leave you with this interesting quote from Warren Buffett, a personal hero of mine. He says, "I used to pull every 10K I could find, especially those that looked uninteresting to others. There was always a chance I'd find something incredible, and I often did. And this is, really meaningful for at this stage of crypto market evolution, where something like Dune Analytics gives us an opportunity to develop a unique insight into a protocol. And I'm really excited for fundamental investing and fundamental analysis to take off more mainstream in crypto markets. So thank you for listening. And yeah, that's it.
If there's any questions?
Oh, questions.
Sonya, thank you for the speech. I'd like to ask you a question regarding the sustainability of the work that you're doing. So, for example, like your company has done a great work, like analyzing the MakerDAO. However, the MakerDAO can, like their community they can come up with a new resolution and accepting like new collateral asset or creating new contract and doing something new. Then in order to analyze additional thing, you have to go over like the the MakerDAO's forum and just analyzing the new contracts and etc.
Yes.
And my question is like, is the work that you're doing is sustainable in terms of that?
I think I would like to say yes. It's very high maintenance because things are changing all the time, as you say. So you have to be close to what's going on, in the community to constantly update. And our, like hats off to our data analysts and data chefs who are actually doing the implementation. I think the trade-off is not sustainability, but maybe scalability. We're a relatively small team of just over 10 people, so there's only so many protocols that we can cover to this level of depth. So I would say yes, sustainable, but scalable, question mark.
Can I ask, like, just one more question? So do the MakerDAO or other protocols, do they report you whenever there's a significant change, or you guys have to contact them or go over the changes?
We're in constant we're one of the contributors, right? So MakerDAO is not a singular organization. It's a group of multiple companies contributing towards this common goal of creating and growing the decentralized stablecoin. So yes, we're constantly chatting with the other contributors on Telegram and meeting up at conferences like this. The beauty of this model is that we're not the central entity reporting on financial analysis. There are other companies such as, I can think of Block Analytica. They have also developed a front end for the Sky ecosystem. I think it's like info.sky.money, where you can see all the protocol statistics. So there's multiple teams actually doing like financial reporting and things that are of that nature, which I think makes for more of a robust ecosystem because you're not just relying on a single entity that's like, called Steakhouse, and you're like, what is Steakhouse?
Thanks for the answer.
Yeah, of course.
Yeah, so I have been reading the Steakhouse Finance report for a really long time.
Thank you.
Yeah, so I was wondering, like, what's your business model? And also, do you think it's scalable? I actually personally really bullish on like the risk manager side, that kind of the sector. So kind of curious your opinion about that.
Well, the co-founders of Steakhouse are not here, so maybe it's a question that you should ask directly to the co-founders. But in terms of our business model, I would say there's maybe like 3 pillars. There's the DAO advisory, so MakerDAO, Lido DAO. There's on-chain products that we're starting to build, like Morpho Vaults. I think we have over 150 million of combined TVL in the vaults that we are risk curators for. And then there's on-chain services, so we're starting to get involved in, say, like liquidity provisioning and things like of that nature. So I think, yeah, I would probably classify us as like broader DeFi specialists at this point, which is very interesting. There are just many opportunities, I think, within DeFi to add value to. So we're constantly open to business, inquiries. I'm not here to shill Steakhouse, but yeah, that's kind of where we are.
Thanks.
Hello. Thank you. Great chat. here at the back.
Oh, hi.
Yeah, very good to hear that there's space and there are opportunities in this market. But I wonder how much you have to advocate for the value of this kind of service. There seems to be predominant mentality of just going to market as quickly as possible and hoping that you can just ride your way to the top. I'm wondering if you're engaging in advocacy and raising awareness of the value of these practices, not just for creating transparency and trust with the community, but also to steer internal decision making and make better use of internal financial resources. Thank you.
That's a really great question. And I've actually been personally very surprised by how many people or DAOs or protocols have reached out to us. I think we're starting to raise awareness of how DAOs can be more sophisticated in terms of their capital resource allocation and financial reporting. And I would characterize many developer-led DAOs to lack financial expertise. So we get inbounds all the time of protocols saying, how should we design our value accrual? Or, how does like a company think about resource allocation? And these are like seemingly very basic questions, but I think there's a lot of value to be added by finance professionals, and this is kind of like my pitch to TradFi, people in TradFi who are bored looking for new opportunities. Like, there are so many opportunities in DeFi where you can, with your financial knowledge, add value. I think I'm very happy and excited about the sustainability of crypto, which people don't really realize what's going on from the outside, but there are nice things and rational things going on inside the ecosystems. I think that's probably all the time we've got, so. Yeah, one more?
We're good.
We're good?
You mentioned scalability was, not really an issue, but just a talking point for MakerDAO. I wonder why that is, especially crypto being so transparent, and it should theoretically be easy to, I guess, break down the data and understand how MakerDAO works. Can you talk about why the scalability is such an issue?
Sorry, so I think if it wasn't clear, when I was talking about scalability, it was like the number of projects that our team can cover being not very great with the amount of resources we've got. In terms of scalability of DAI, or USDS, the decentralized stablecoin, we were limited by just crypto loan demand when we were at just crypto-backed vaults, crypto-backed collateral. But this completely shifted when we got into real-world assets. Now we're only limited by how much like U.S. Treasuries is in the market, because you can mint DAI against collateral that's like just addressing the largest markets, which is global fixed income. So I would say that was really the unlock for the scalability of DAI, and we're really excited to see how it can scale with real-world assets.
Give it up for Sonya one more time. Thank you for
Thank you.
this presentation.